When looking at support material 5, you'll see this support material looks very much at a specific line item in the actual taxable income calculation. First thing that we need to look at is just a recap regarding income for a specific business. You probably remember the different types of businesses in terms of classification. We get a small business corporation, we get a micro business, and obviously we get larger businesses like corporates that get taxed in a certain way. Do you remember that?
Yes. Yes, sir.
Okay, so do you remember the difference between a resident and a non-resident?
Not really, but I think I remember a resident being someone that is seen to consider South Africa their place of, I suppose, their place that they stay in or the place that they come from.
Yes, yeah, that's correct in terms of an individual, but when it comes to a business, or how do you determine whether the business is a resident or not? There was something specific in terms of the theory, the definition, the legislation. Do you remember what they referred to? There were a few things actually.
The place in which it was incorporated.
That's right. Good. Okay, so obviously for a business, you can't really say the business is going to live in a specific area, because a business doesn't or isn't living. It's just an entity. It's separate in most cases because, for example, a company or a close corporation would be incorporated separately from the shareholders that hold equity in the business. But yes, the residency based on a company is determined by a few things. So as you said, where the business is incorporated. Something else that we looked at the previous week was, where does it derive majority of its income? So are they deriving income primarily from, let's say, South Africa or other places? And then they also looked about effective management. So where are the board of directors sitting? Where does the majority of the decision making take place? And then something else is also about income. Okay, so I think they spoke about the economic nexus. I think that was the right term that they used to describe where does the business generate its most benefit. So if the benefit comes primarily from South Africa, well then it could possibly be considered a South African company, depending on all of those factors that were mentioned previously. So the reason why we need to determine if a taxpayer is resident or not is because that whole worldwide versus South African source kicks in. Okay, and then obviously we'll tax the entities based on that consideration. And when looking at residency, you can either look at a natural person, so an individual, or you can look at a juristic person. It doesn't actually matter whether you've got a natural or juristic. This whole idea of residency and non-residency still applies. So if I'm a natural person, then I'm going to be looking at time that I spend in a country. So for example, do I consider this country home? If so, then you would be considered an ordinarily resident of the country. Right, if you do consider a different country your home, then it comes down to, well, were you physically present in the country? Obviously, if you're in a country for a longer or an extended period of time, well, then you're definitely going to be considered a resident. And that's just how the system works from an individual point of view. Obviously, the course that you're doing is focusing on this, juristic persons more than individuals. So you need to look at that. Place of effective management, operations, and economic nexus. That's what they're looking at in terms of the definition. Is that alright?
Yes, sir, that's alright.
Okay, good. So just remember that theory is important, because I've seen past papers in the past, and they do test application of theory. So for example, they might ask you about the requirements to be classified as an SBC, or they might ask you for the requirements to be classified as a micro business. So don't take it for granted that they're not going to test you on the details regarding like the background information. For example, how to determine residency of a company would be theory. As long as you've got a question that talks about this company as being a taxpayer, well then you can assume all of this has taken place. But if they ask you a separate question about it, then you can't assume that you would have to go through the process to distinguish whether this business is a taxpayer in the Republic, okay, so being taxed as a resident, or outside of the Republic being taxed as a non-resident. But generally at this level, the questions are quite basic, relatively simple to interpret, and I haven't really seen a very long question about this yet. In previous past papers, I've seen shorter questions just describing a little bit of this whole idea of effective management operations and that type of thing, but I haven't seen like a big question about it. I have seen questions relating to like income and deductions and those sorts of topics, but when it comes to the actual distinguishing between resident and non-resident, there hasn't been that many questions on it, or let me say there hasn't been that many long questions on it. There have been short questions on it, but it is important obviously because we need to decide on how to tax the actual business. Once you know what they are, resident or non-resident, then we're going to be calculating the taxable income. Taxable income is what we actually use to tax the business. Okay, that's where the rates come in. So how is an SBC taxed?
An SPC is taxed according to, well, it's got its own tax tables, I suppose.
Yes,
good.
Okay, so remember from chapter, I think it was 1 or 2, we spoke about a progressive tax system. So an SBC would be taxed using a progressive tax system.
Yes, sir.
If we're a company and we don't fit into any of those smaller categories, meaning, let's say we're a corporate and we don't fit into the SBC category and we don't fall into the micro business, how are we then taxed?
We were taxed on, I think it's 28%.
Correct. Yeah, you're taxed at a flat rate of 28%. And again, from chapter 1, they spoke about a proportional income tax system. So proportion means it's a percentage of. That's what you're looking at there.
Yes, sir.
Right, and then for a micro business, same thing applies. It's a progressive system, meaning in the lower or the smaller levels of income. Okay, but remember there you're not looking at taxable income. For a micro business, taxable income isn't what you're looking at. In a micro business, you're looking at the turnover.
Turnover, yes, sir.
Yeah, which is completely different. Turnover is looking at sales, not taxable income. What's the difference between turnover and taxable income?
Well, taxable income is derived on all the income or all the specific income that you derive, or rather that you get,
Less?
And turnover, less deductions.
Good, that's important.
Yes, sir.
Yeah, that's the key. That's the main difference. Taxable income will take out the deductions. Turnover doesn't. It's just the top line sales revenue, basically.
Yes, sir.
Okay. Then you've got the tax year for individuals. Okay, we've spoken about this, 1 March to 28 or 29 Feb. And obviously for a company, which is what we're looking at, the financial year could be any 12-month period. So it could start in January and it could end in December. It could start in June, okay, and it could end in May. Okay, so 1st June to 31st May, that type of thing. Right, as long as it's the full 12 months, it doesn't have to be the same as the tax year for an individual. Right, obviously for certain companies, for example, the micro business, then the tax year needs to be the same as an individual. Okay, but that's slightly different. That we saw. I think we saw that last week. If not, we'll probably see it again this week. Okay.
Yes, sir.
All right. Don't forget the general formats. What I've put here is important in terms of approach. So if you're going to be working out the tax liability of a company, you're going to have to split the calculation into different sections. The section that we're looking at tonight is focusing on this, the income. Next week, Chapter 6 is going to focus on deductions and allowances. And then the final chapter, Chapter 7, is going to look at the taxable capital gain. Okay, that's why these last few chapters are quite important, because it basically brings this big picture together, because you're trying to get to taxable income, and then once you've got that, you'll then apply the rates.
Yes, sir.
Okay, so how do we define income? Well, income in terms of the gross income definition, comes from the Income Tax Act. So when looking at income of a business, we're going to be focusing on this. Total amount, in cash or otherwise, received by or accrued to in favor of a person during the year of assessment, excluding amounts of a capital nature. Okay, that's the gross income definition. Right, remember,
Yes.
gross income is that top line item. Do you agree?
Yes, sir.
Okay, and generally everything that's income or gross income will be included. So with SARS, remember, they want to know as much information as possible. So we do get different types of income. You get income that's exempt. If something's exempt, does that mean we take it out or we leave it in?
We take it out.
We take it out. And then you get income that's specifically included, meaning that it's not covered in terms of gross income, meaning it doesn't meet the definition, but you specifically include it. Right, those are two separate considerations in terms of income. Exempt income, exempt meaning it's income, so we can't take, so basically, let me put it this way. If income is income, you cannot not include it, because
Yes.
SARS will want to see all the income. Whether it's exempt or not, or whether it's specifically included or not, is irrelevant. The thing is, if it meets this definition,
Yes, sir.
you have to include it. But some income that you do include will be exempt, and then you specifically remove it. Some
Yes.
income that's not part of the definition must be specifically included. Okay, that's why you
Yes.
get these two things, exempt income and special inclusions. The one you put in, if you're including it in your taxable income calculation, that's going to increase the tax that you're going to have to pay. If you're
Yes.
exempt, if it's exempt, or if you're going to remove it, it's going to reduce the tax that you pay.
Yes, sir.
Right, so how do we know what's what? Well, this is where case law comes into it. Okay, what is the purpose of case law? Why do we need it?
Well, case law is there to establish precedents, so that what
Yes.
was applied before can be applied this time.
100%, that's good. Okay, so obviously we follow a law of precedent in terms of court cases that arise will impact future cases that take place. So that's why when looking at something like this, gross income, previously we spoke about the burden of proof. I don't know if you remember that.
Yes, sir.
Okay, good. So let me ask you this. Let's assume that you are running a photography business and
Yes.
you've received income from the sale of your equipment. Okay, so that means
Yes, sir.
you sold one of your cameras.
Yes, sir.
All right. Are you going to include that in gross income? Well, probably
Yes.
not, because if you're selling the camera, it's probably going to be seen as capital. Do you agree?
Oh, yes, yes, sir.
Okay, because you're not selling cameras, you're selling your services in terms of taking the images.
Yes, sir.
Okay, but if you were in the business of selling cameras, well, then it would be part of your main course of business and not capital in nature. So the biggest consideration is this. Is it capital or isn't it? So if I sell, so later on we'll actually look at this whole idea of tree and the fruits.
Yes, sir.
Okay, where you have apples on the tree. If I sell the apples, it's generally called income because I'm not selling the tree. If I sell the entire tree, then I'm selling the capital. I'm selling the actual tree. Does that make sense?
Yes, sir.
Okay, so it's the same when it comes to your photography business. If you sell the cameras, that will be your equipment. So that'll be capital in nature. Unless you're also in the business of buying and selling equipment, well, then that could be considered income. Right, if
Yes.
it's considered capital, it's taxed according to CGT. If it's taxed according to income, it'll be taxed according to your tax rates or your flat rate, depending on whether you're a company or individual or SPC or a micro business. Okay, most important bit is the interpretation. SARS will have, they call it practice notes. So SARS will give guidelines in terms of how you should treat certain things. For example, they'll say, well, if it's this case or if it's that case, this is how you should treat it. All right, and
Yes.
they give practice notes. So they give guidelines, they give guidance on how to treat certain things. Make sense?
Yes, sir.
Okay, so when looking at income, do you agree income is looking at what line item? The top or the middle? The top.
The top, yes, sir.
Okay, study unit 5 is looking at the middle, which is looking at the trading deductions. Okay,
Yes,
so
sir.
what are we looking at here? It's the deductions, meaning what
What
I
we're
can
taking.
remove from
Income.
income.
Yes, sir.
Does that make sense?
Yes, sir.
Okay. I think the tree and the fruit we actually spoke about previously.
Yes, CIR was first, yes, sir.
Yeah, I think I'm thinking about study unit 4 instead of study unit 5 because that was that whole income discussion. I don't know if you remember that.
Yes, sir.
Okay, I think it was the FISA case, if I'm not mistaken.
Yes, sir. Yes, CIR was first, sir.
Okay, did you see that in your notes?
I remember it, but I
you
do
remember?
remember. Yeah, I remember because you did say that more likely than not that I'd probably be quoting the FISA case
Yes.
more often than not.
Correct. Yeah, there are certain cases that you should remember because they're like one of those key cases. The textbook is actually not the textbook. The study guide,
study guide.
UNISA study
So-
guide is actually quite good because they actually give you little snippets of the actual cases. But
Yes,
remember, you can actually like find these cases online if you search because remember this is South African law, and if it's African law, it's open to the public.
Yes, sir.
So those judgments that have taken place previously, it's part of public knowledge. It's in the public domain. So
Yes.
you can actually search and you can find the FISA case. There's a few others, the Lartagon case, the
Yeah,
Pepstore case. There's quite
Yes,
a few
People store.
like popular cases that we mentioned that UNISA could possibly test, or if they don't test the specific case, it's actually quite nice for the examiner to see that you've included some of the theory. So if you want to impress the marker, you would try include some of the cases in the actual answer that you provide. It gives a very good impression.
Yes, sir.
Okay. All right, so introduction. How do companies generate profit? We've spoken quite a bit now. We looked at quite a bit of revision. If we're talking about the profit side of things, what are we going to be looking at?
If we're looking at the profit, we're looking at your income minus whatever expenses you incurred to generate that income.
Very good.
Generate that profit, excuse me.
Nice. That's a good answer. So obviously the expenditure is used to generate the profit. Okay, so do you agree? Let's assume that you were running a business where you had no expenditure and you just generated income.
Yes, sir.
Would you want to register as a micro business?
I'd probably want to either a small business or a micro business, but not a company.
Oh, okay, yes. Why? Because can a micro business, or let me ask you this: if there's no expenses or very little expenses,
Yes, sir.
okay, would you have any things that you would want to claim?
No, sir.
No, you wouldn't. Okay, so do you agree if the company doesn't have too many expenses, well, then there aren't any or that many expenses to claim. And if there aren't many expenses to claim, well, then the business isn't going to worry or stress about the expenses. Do you agree?
Yes, sir.
Okay, because there won't be that many to worry about.
Yes, sir.
Right, so if that's the case, well, then turnover tax might be a good option. Because now we're just going to tax the sales rather than claiming or having to claim for any deductions. So the only types of businesses that would want to register as a normal business and claim their expenditure are businesses that want to make use of the deductions.
Yes, sir.
Right, so do you incur any expenses when you are doing or conducting business?
Yes, sir.
Okay, such as?
Me personally.
Yes.
Well, yes, because obviously I have to travel to wherever I'm going.
Okay, so travel is one.
Yes, sir. I don't know if I can maybe say perhaps maybe wear and tear of my equipment is.
Okay, wear and tear, not quite. But
Yes.
if you had to repair it, maybe, yes. So repairs would be considered a form of an expense. But Obviously, if you're upgrading or improving the asset, then it would be seen as something different. So
Yes, sir.
that one's a bit tricky. But let's talk about the stationery that you use.
Yes, sir.
So you might be saving the images to a
Hard
SD
drive.
card or a hard drive, and then the hard drive or SD card will be given to the client.
Yes, sir.
So if that's the case, that would be seen as a consumable, something that you've used up in the business. Okay, or
Yes, sir.
maybe you print the images and videos to DVD, and then the DVD is what you sell the clients.
Yes, sir.
Okay, then that would also be seen as what? An expense that we've incurred in order to practice or operate as a business.
Yes, sir.
Right, so do these items benefit the company?
Yes, sir, they do,
How?
because they help me generate income.
Correct. So if they are so important in terms of being able to operate, surely SARS should incentivize you to incur those expenses.
Yes, sir.
Well, they should try. Okay, they should try and incentivize you to help obviously build the economy because your expense is someone else's income.
Yes, sir.
Right, and that's how the economy basically operates. It's just a form of exchange. It's exchanging value for something else. Okay, either exchanging value for value, like a barter type system. Okay, where let's say you've got stationery and let's say I've got textbooks. Okay, and then we could exchange stationery for textbooks perhaps. Okay, that's like a very old system of exchanging items for value because as a business, the business cannot produce everything themselves. Right, and that's why
Yes.
most businesses would exchange or trade or do business with other forms of businesses. And that's kind of what we're looking at here. It's if you're doing business with other businesses, those expenses that you're incurring, is there any benefit that you could possibly get from those expenses? Well, what do you think?
Well, I do think so, sir. Like in some cases, for example, I believe there are certain like expenses that you might incur that not only help you conduct business, but also help you to further extend your business. Like I suppose like networking type of expenses, where perhaps maybe you take your client out to try to secure some sort of a deal with them in some cases.
Yeah?
Um, and yeah, I think, and then perhaps maybe that client not just giving you one contract, maybe giving you two contracts.
Yes.
So through having spent or having incurred a little bit of expenditure, you've then gotten maybe triple the income than the expenditure that you might have incurred.
Okay, yeah, that's a good way of looking at it in terms of like incurring expenses to reap some benefit. That's possible. So,
Yes.
so yes, you've got the right idea. But remember, the main thing that we're trying to look at here is, well, would you have been able to conduct business without those expenses?
Well, you could have, if
No,
depending on.
really. So you would be able to take photographs if you can't get to the venue.
Well, that was going to lead to like my next point, as to perhaps maybe if I didn't incur the expense, but perhaps maybe I got someone to drop me off at no expense.
Oh,
But
okay. Well, yeah, that's something different then.
yeah,
Yeah, but obviously then you've got a really good contact or friend or business partner. Then sure. Obviously, the transport would have been covered in that instance. But
yes,
in most scenarios, okay, maybe that's a once-off. So maybe someone helps you go to the photo shoot. Okay, let's say you're filming or you're taking photographs at another fashion show, and you need to get there, and then you're obviously going to have to pay for transport. But maybe someone you know is also going to the photo show or the photo shoot or the fashion show, and then you both go together, and they end up not charging you. So in that
yes,
case, there wouldn't have been an expense. Do you agree?
yes, sir.
But had you not received the lift from the friend or the person attending the same event, would you have been able to make use of that benefit?
No, sir.
Well, it depends. If you're operating a business, then you would have certain deductions and allowances.
Yes, sir.
Okay, so the main benefit of these deductions and allowances is not only to operate, but also to reduce taxable income. Because
Yes, sir.
what does a deduction do to the taxable income? Does it add to it or does it decrease it?
So what's it?
What does the deduction or allowance actually do to the taxable income?
It decreases, sir.
It decreases it. Why? Because remember, a business is looking at the output.
Yes, sir.
Okay, so output that's created would have come from somewhere, and that process, that supply chain, right? So getting from start to finish, okay, that whole creation of a product takes time and effort, and that time and effort that you spend providing or creating or making the product is then rewarded in the form of a deduction, right? So do
Yes.
you agree? Would SARS have been part of the transaction?
Well, no,
No, they
it
wouldn't.
would.
But do they benefit from the transaction?
Yes, sir.
Yes, they do. Right, and that's why they kind of offer a little bit of rebate in terms of not being over taxed or taxed too heavily for the purposes of running a business or conducting a
Yes.
business.
Would you say, so if perhaps maybe, let's say in my business, I'm a VAT vendor, is SARS then, I suppose, in some way included in the transaction, or is he still just reaping the reward of the transaction?
Well, if you're the middle person, let's say you're the retailer and you're the one selling the goods, okay, and you're collecting this income from the sales of the goods. So do you agree all the income that you would have derived from that day's shift would have gone to where? The company or business is safe, do you agree?
Yes, sir.
Okay, or deposited straight into the bank account, right?
Yes, sir.
Okay, if it isn't and it's physical hard currency, cash, in the actual business, then you would have to trust your friends and family members, okay, and maybe your wife and other people to prove that those funds are being used for the right reasons.
Yes, sir.
Okay, because that's the biggest challenge that companies have currently is being able to identify, what currency, not currency, what benefit do you get from the exchange of the currency for other goods and services? Is that alright?
Yes, sir. Sorry. Yes, sir.
Okay, so if I'm looking at the benefit is always going to be, from a tax point of view, something monetary. Right, so SARS is not going to tax you much if you don't earn anything.
Yes, sir.
Okay, if you start earning more and more and more and more, then tax starts to kick in because now you're actually deriving a benefit from having a particular product or service.
Yes, sir.
Okay. So you've looked at this before. We just recapped it tonight. Remember, income is looking at what?
Income is looking at all the benefit that you have derived within the year.
Good. And income meets the definition of?
Gross income.
Yes. Okay, so gross income is considered income. And obviously income can be grouped into different subcategories. Okay, so you
Yes,
get
sir.
income that could be seen as, what's the right... things that you like everyday stuff, and then things that you don't really, almost luxuries, if you will. Okay, but so
Yes,
for
sir.
example, you would have to identify what items you bought and where did you buy those items, and then depending on whether you got the proof. Right. So are the source documents important?
Yes, sir.
Very important. Okay, because if you're conducting business, you should keep all of that record, or the record keeping, because the record keeping would tell other investors or other families what you're trying to do and what you're trying to achieve.
Yes, sir.
Okay, so slightly different consideration here because we're looking at the business and we're looking at a doctor or someone else that might be wanting to purchase certain products. Okay, so obviously a doctor would have income and a doctor would have certain deductions and allowances. Okay, and a doctor would probably operate as a sole proprietor, maybe in a partnership, maybe even a close corporation, okay, or a larger company. Okay,
Yes,
so it
sir.
doesn't matter what the taxpayer is or who the taxpayer is. The taxpayer needs to be identified. Okay, so a doctor as an example, and then that individual having to pay taxes. Right, majority of the time we're going to be looking at juristic people. Okay, juristic meaning?
Companies.
Companies, yes. Right, and how do companies then pay tax? Okay, that's
Yes.
a good word that we're going to focus on. Okay, so remember a deduction is what? Something that makes the taxable income more or less.
Less, sir.
Exactly, because you're subtracting this. Right, so the
Yes,
bigger
sir.
this gets, the smaller that gets. And if the taxable
Yes.
income gets smaller, do we end up paying more or less tax?
Less tax, sir.
Exactly. You'll start paying less tax. So if you're paying less tax, but it's still in line with the rules and laws of the country, does that help the business?
Yes, sir.
Yes, it does. Okay, it helps the business because now the business will have more disposable income to use elsewhere in the entity.
Yes, sir.
Okay, so why do taxpayers want the deductions? We just discussed
Well,
it.
well, as like you just said, to be able to keep more of their income, to be able to, I suppose, use it within their business again, or rather to hold more to hold more liquid assets, I suppose, or hold more money, I suppose, so to say.
Yeah, so in a way you're right in terms of cash flow perhaps, because do you agree if there's a deduction, does that increase or reduce the taxable income?
If there's a deduction, that decreases the taxable. Yes,
Okay, correct. It would decrease the taxable income that you would have to pay. Right, so as
yes,
a company would be very, very, very interested in claiming its deductions. Do you agree?
yes, sir.
Right, so do you think SARS is going to allow you to claim everything?
No, sir.
Why not?
Um, because they have rules for everything. So there are certain things that you can claim. Well, there are certain things that you can claim a deduction on, and certain things that you can't claim a deduction on that they would preferably like to tax, because they have to generate. I don't want to say generate an income, but they have to generate money from all of the tax to be able to run the country, or to be able to give to government to run the country.
Okay, that's good. So your understanding of the background is very, 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 very good because you kind of get how the system works.
Yes, sir.
Okay, so obviously the deductions and allowances will reduce the taxable income because you're going to be able to claim it against your income.
Yes, sir.
Okay. Next bit. The general deduction formula. Okay, the general deduction formula comes from section 11A. This is a very, 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 very popular section in the Income Tax Act. And the reason for this is it gives you the general. So this would be the general checklist that one would have to go through to determine if something is deductible or not.
Yes, sir.
Okay, it's almost like identifying a product. Certain products have certain features. And if you've got the same product, you'll know what the features are.
Yes, sir.
Okay, so when looking at this, we're looking at how well do you know the even the individual, we could say, but basically it's looking at, well, in terms of a deduction, would I be able to claim or wouldn't I be able to claim on a specific expense?
Yes, sir.
Because are these expenses incurred during the life of the business?
Yes, sir.
Yes, they are, generally. Right, and obviously people are littering, that's a problem, but you're right. Okay, those bottles should be recorded over the life of the person.
Yes.
Sorry, not person. Sorry, person. Okay, so remember you get juristic or you get natural. So it'll be on behalf of the person.
Yes, sir.
Okay, so that's general deduction. General just means it must meet the criteria. Okay, it's almost like general. Like, for example, what makes a laptop and what makes a tablet a tablet?
Well, what makes a laptop is I suppose, the flip up kind of screen,
Yes.
flip up screen, and separation in the keys and the monitor.
Yeah.
And the tablet, I suppose, it's all in one with the screen and monitor and keys are basically all in one interface almost.
Good. So if that's the case, would that family want to deduct anything?
Which family, sir?
The family we just mentioned, like somebody having a deduction, like obviously income and expenses, and then being able to deduct it.
Yes, sir.
Yeah, you would. Okay, so general deduction would be taking everything into consideration, literally everything. If it's a business, it'll be everything that the business does to run the business. If it's a family, it'll be everything that the family uses to run a specific business.
Yes, sir.
Okay, so it doesn't matter. Not legal, yeah, well, legal, juristic, or real in terms of individual human beings. The tax pay is irrelevant. It just depends on what are you. Okay, are you a company? Are you a person? And depending on whether you're a company or a person, you'll be taxed accordingly.
Yes, sir.
Okay, so the first one is actually incurred. Do you know what that means from accounting?
I believe that that you actually, I don't want to say that you actually did incur it, but that you incurred it within the period, the year of assessment, almost to say, irrespective of when you got the benefit.
Kind of, but remember, you're kind of looking at 2 points. You're kind of looking at point number 1 and then point number 3, which is in the production of income.
Oh.
Okay, because you're saying, well, what did I use that expense for, type of thing.
Well,
okay,
I'm saying
correct.
Yes, or the way that I'm looking at it is saying, basically, I'm looking at the accrual principle, basically, in the sense of like saying that that I've incurred this within this period, even though whatever benefit that I'm supposed to receive or reap from it, I might not have actually received as yet.
Okay, but did you still incur the expense?
Yes, you did.
Yes. Would you want to claim it?
Yes, in this period.
Yes, if you're running a business. See, that's always the disclaimer, though, hey?
Oh, okay. Oh, so what, are we looking at business or individuals? Yes, sir?
Either or, it would apply to both.
Yes, sir.
Okay, because the sole proprietor would have the same considerations.
Yes, sir.
Business, same thing. It's just now the business is thinking in terms of the influence, okay, the effects. Right, so is there a case for this? Yes, there is. Right, it's called the Edgar Stores case. Actually incurred based on an accrual basis. Right, accounting is very useful here. That's why I put the word accounting treatment. Just think back to your FAC 1502, okay, and later accounting modules, and always consider the reason why people are doing what they're doing. Okay, the purpose. So now, if you can uncover what the motivation was, is it possible to determine if this was actually incurred or not?
Yes, sir.
Yes, it would. Okay, so actually incurred meaning it must be part of the business.
Yes.
Okay, so let's say you're in photography. Do you agree?
Yes, sir.
Okay, let's think of an expense that you could have that wouldn't be focused on the business. Can you think of one? Something that you incur but not directly associated to the business.
I'm trying to think. Perhaps maybe. I don't know. I'd maybe say, but then I'd probably look at this as more as like a drawing kind of type of situation. But if perhaps maybe I went to go shoot a client, and then when I came back or on my way back, I stopped by and got something to eat, perhaps.
So what happened there then?
Well, in that case, I would be looking at saying that it wasn't really specifically associated with me being able to complete or rather get the job done, but it was within perhaps maybe my rounds of doing or rather going to work, but not. In other words, I would have been able to do the job with or without having eaten, but I still incurred that cost because I still ate nonetheless.
Okay, so is that a business expense? Eating?
Well, like I said, I'd be in my mind from accounting, I'd be looking at it as in terms of like a drawing type of situation. But I would probably still look at it in as it being some sort of an expense that the business has incurred, kind of.
Yeah, so that's why the first bit is so important, actually incurred, because it needs to be incurred by the business. So, for example, if I pay for expenses for your business, have you actually incurred it?
No, sir.
No, you haven't. Does that make sense?
Yes, sir.
Okay, and that was the big debate here in terms of the Edgar's case. So the Edgar's case spoke about this whole debate about whether something should or shouldn't be included.
Yes, sir.
Right, when claiming against somebody for something.
Yes, sir.
Right, obviously here you're claiming against who?
You're claiming against someone. You're claiming against someone that has given you income.
Yes. Okay,
yeah,
correct. Good. That's better. Nice. All right. So just remember that accounting treatment is something that can help you determine if something is actually incurred. Actually incurred means it actually took place. It actually like sort of materialized. It actually happened in a way.
Yes, sir.
Okay, so there's a lot of different synonyms we could put in place of incurred. You could say actually happened, actually paid, actually took place, actually transacted, etc., etc.
Yes, sir.
Okay, very important. Interpretation is always the key. Right, so what do we do to interpret? We use case law to help us determine if something has or hasn't been actually incurred.
Yes, sir.
Okay, so for example, let's say you have rent as an expense and you pay your rent for the next 2 years.
Yes, sir.
Thoughts? Actually incurred?
Well, you haven't actually incurred it because you've basically paid it in advance, basically.
Correct. So what does that mean?
So
Prepaid expense.
Yes, sir.
Okay, and that wouldn't be something that was actually incurred.
Yes, sir.
Okay, because actually incurred means it actually gave rise, or it did give rise to an expense in that particular period. So here's the example. You buy SD cards for your camera so that you can take photographs.
Yes, sir.
Okay, those SD cards haven't been used yet, but you have spare ones sitting in your office, and the one that you do use would be considered as having actually incurred a cost.
Actually being used. Yes, sir.
Yeah, so you might have bought things in advance, then it's slightly different. Then it's more a prepayment.
Yes, sir.
Okay, then they apply a slightly different scenario or situation. So the next one is very self-explanatory. During the year of assessment, that's looking at timing. Why do you think timing is important?
Well, it's important because it has to be during the, I suppose, the 12 months in which, or rather your year of assessment or your period of when you're running your business. So it has to be from, like, for some businesses from the 1st of March to the 28th, 29th of February in the next year. So anything that falls out of that period is then not included.
Why isn't it included? Because it's not part of the year of assessment.
Yes, sir.
Do you agree?
Yes, sir.
Okay, so the year of assessment is actually very important. So if you actually incur an expense, it must be during that period, from start to end.
Yes, sir.
Anything that takes place here would be part of the year of assessment.
Yes, sir.
Okay, anything outside, not. And that's why you'll have to adjust for those other things, which you kind of saw in some of the questions that I took you through last week.
Yes.
Okay, next bit. Before I get there, just the note here. Individuals have a year of assessment, which is 1 March to 28 Feb, 29 Feb, depending. Companies have a financial year. Right. Do you think case law is important here? No, because, I mean, you can't argue with the calendar. The calendar is what it is.
Yes, sir.
Right, production of income. What do you think this relates to?
I think this relates to, well, it can't be a deduction if you didn't incur it while trying to produce some sort of income. So if you are not operating your business, I suppose, for it to be a deduction, it must have been within the bounds or within the confines of you trying to make some sort of money for it to then be a deduction. So if I incurred a cost for just taking out my friends to, I don't know, Gold Reef City, for example, for the day, that's not something that I could be trying to get a deduction on, as opposed to if I was trying to maybe take my client to go shoot at Gold Reef City and I incurred maybe an entrance fee of some sort, then perhaps maybe that could be looked at as a deduction because it was within me trying to make some sort of money.
Okay, but if it's a conference type thing and you're going to a place where there's entertainment, you need to be careful with that production of income.
Yes, sir.
All right, because you're saying you're going to some conference or entertainment place. So now, okay, let's use your example as a photographer.
Yes, sir.
Okay, as a photographer, you are gonna go out to a bar or a nightclub to take photographs.
Yes, sir.
Okay, and you go to the bar or the nightclub. Is that in the production of income?
Well, I'm not going to the bar income for my own personal gain. I'm going there to create income. So I would believe yes, sir.
Okay, as long as you have a contract to shoot at that venue, then you could possibly say, well, that's in the production of income.
Yes, sir.
Okay, but if you're not actively doing business at that place or during that time, it's going to be very difficult to prove that.
Yes,
okay,
sir.
That's why I put next to this, the keyword is operating. Okay, so for a photographer to go to an event, okay, would that be seen as in production of income? Probably.
Yes, sir.
Okay, but for a spectator going to an event, would that be in production of income?
No, sir.
Probably not, because they're a spectator. They're not doing any sort of business.
Yes, sir.
Okay, so it's very important to understand what are we doing as a business. In other words, our operations. Okay, how are you operating? What are you doing? Are you buying and selling goods? Are you providing a service? Are you helping people? Like, what are you doing? That's the key. Because if you know what you're doing, that's going to determine whether this is actually in production of income or not. And they would then have to check, well, what are you actually doing? What is the main purpose of the business?
Yes, sir.
Okay. Not of capital nature. Oh, before we get there, just the case. This is looking at the PE electric tramway case. Okay, that you can add to your notes. That I haven't. I don't think I've put that into your notes. You'll have to add it. It is in the study guide and textbook, though.
Yes.
Okay, so how I like to remember this is PE electric tramway. Okay, they talk about inevitably an inevitable concomitant, or they look at the closely connected test. Right. So let's talk about photography. Okay, if something is closely connected. So let's say in production of income. Oh, okay. Let's say you're going to take photographs of a model. Let's say.
Yes, sir.
Okay, but now you're going to have to buy the clothing for the model as well.
Yes, sir.
Okay, would you be willing to, or would SARS be willing for you to claim the clothing that you would have bought?
Well, I think so, because I mean, I was trying to get the clothes to create, or rather, to make some sort of money.
Okay, so let me ask you this: the clothes that you wear to the photo shoot, would you be able to claim that?
No, sir.
Why not?
Because if I'm wearing them, how am I deriving an income from my wearing them and me shooting?
Okay, well, it does actually get a bit more complicated than that. So I think maybe that wasn't the best example because the legislation provides for uniforms. So, for example, if you have a specific uniform and you have to wear it to work and you have to buy that uniform, you can actually claim that.
Yes, sir.
Yeah, so it's not the best example to give you, but obviously there's no uniform for a photographer, right?
Yes, sir.
Yeah, I mean, it's just anything. I mean, if you wanted to, you could take photographs naked if you wanted to, but obviously that wouldn't work.
Yes, sir.
Okay, but I mean, obviously in production of income, we're talking about the clothes that the model is wearing. So if the model is modeling clothing and you have to buy clothing for the model, then that would be in production of income. Because without the model wearing the label, whatever the brand is, then obviously you wouldn't have taken the photographs.
Yes, sir.
See, that's different, because now that's in production of income, because you're actually taking photographs of those items that you're going to be using in the photo shoot.
Yes, sir.
Yeah, that's a bit different. So even if you rent the venue, is that in production of income?
Well, I'm renting it to try and make income, so I think so.
Definitely, yes. Okay.
Yes.
And that's why they look at this. Closely connected.
Yes, sir.
Right, so do you need a studio to take photographs? Probably. If it's inevitable concomitant, meaning something that you have to do, something that has to be linked to it. Alright, and that's why, like, uniform. Uniform is linked to the business. So if you have to buy uniform, it would most likely be deductible in production of income.
Yes, sir.
Okay, if it's closely connected, meaning it's not directly linked to the actual production of income, but it's closely connected, then they apply a specific test. And again, do you agree it's very subjective?
Yes, sir.
Okay, because you might say, well, yes, I have to claim this as an expense because I incurred it when I had to render the service or provide the photographs or whatever the case might be. But then someone else might say, or SARS might disagree, and SARS might say, well, no, it's not closely connected, it's distant.
Yes, sir.
Okay, because maybe they might say, well, the clothing isn't what you're actually taking photographs of. It might be the venue, or it might be something else. So then it might be a bit different. So it becomes, put it this way, it becomes very subjective. And if things are subjective, what normally happens?
I think case law comes into it.
Yes, burden of proof.
Yes, sir.
Okay, so if you say, well, no, you have to claim this, then SARS is going to say, well, then prove it.
Yes, sir.
Okay, and if you can provide the proof and the evidence to support why you believe it's in the production of income, then they will review it, and then they might give you a tax concession.
Yes, sir.
Okay. Alright, the next one, not of a capital nature. This is important because we spoke about your camera and then the actual SD cards that you use in the camera.
Yes, sir.
Okay, or the lens. Would the lens be equipment, or would the lens be in production, income in nature?
I'd need without the lenses, my camera does not function.
Exactly.
So I think it's in capital. Well, it's income in nature.
No, it would be capital. The photographs that you take using the camera and the lens, that's the income.
Income, yes, sir.
Okay,
yes, sir.
So that's why with capital, the key is the tree and the fruit principle.
Yes, sir.
Okay. Over here, they use the new state areas case. That's the popular one. Right, so with case law, capital versus income, you can talk about the new state areas case. And then just to summarize it, it looks at expenses not of a capital nature. Okay, so when you talk about this case, you can say, well, this case assists in determining whether something is an expense that is income in nature or capital in nature. That's the big debate. Right, and what they basically said was, well, if it's what do they call it? Enduring benefit. That was the word. I think I wrote it down here. Yes, I did. There's it. It's on the next page. Enduring benefit. So let me ask you this. Do you have the camera lens after you've taken the photo shoot?
Yes, sir.
Yes, you do. Okay, but do you have the photographs after you've taken the photo shoot?
Once I've given them to the client, no, sir.
Yes, see, it's different, eh?
Yes, sir.
Okay, so enduring benefit is what they normally use to determine if something is capital in nature. Okay, so obviously the camera lens will have enduring benefit. After the photo shoot, you still have it.
Yes, sir.
Okay, but now after the photo shoot, do you still have the venue?
No, sir.
No, because the venue you probably would have rented out.
Yes, sir.
Okay, and if you rented the venue, okay, if you leased the venue, well, then that lease would have been seen as an expense, not an expense of a capital nature.
Yes, sir.
Okay, that's the biggest consideration. Operations versus structure. I like the word structure because when I see that word, I think about the tree and the fruits.
Yes.
That's the best example I can give you for capital in nature.
Yes, sir.
Right, and then the last bit here is looking at laid out or expended for the purposes of a trade. Okay, so do you agree you are a photographer? Do you agree?
Yes, sir.
Okay, let's assume now you are going to be laying out or expending money for the purposes that are not part of your photography business but something separate.
Okay.
Okay, let's say you laid out expenses for... let's think of this carefully now. Okay, let me actually use you as an example. So, do you spend money elsewhere other than on your business?
In my personal capacity or in the capacity of my business?
Well, remember, you're the business. You're running a business.
Okay,
So,
well,
have you
yes.
laid out or expended money not for business purposes?
Yes, sir.
And what could you give me as an example? That it had nothing to do with the business, but it was expended.
Suppose using money to go out.
Okay, so good. Using money to go out, socializing.
Yes, sir.
All right, so that's actually a very good. Example. Okay, so do you agree? As a photographer, you need to network to try get more people to perhaps give you opportunities or jobs to take photographs of certain things.
Yes, sir.
Okay, so you might have been invited to some social event and you went there voluntarily. Okay, would you say it was laid out or expended for the purposes of a trade? So is your trade going to social events and partying?
No, sir.
No, it's not. Your trade would be taking photos of events at parties and that type of thing. Does that make sense?
Yes, sir.
Right, so if you laid out or expended money for anything other than the purposes of a trade, that would be not
Yes.
allowed. So, for example, you went socializing, you went to a bar, let's say.
Yes, sir.
Okay, would you be able to claim the entrance fee to the bar?
No, sir.
No, you wouldn't. But let's say you paid to go to an event, and at the event you took photographs.
Yes, sir.
That would be different. See, it would be more, you probably would be able to get away with that event as being part of your
Business.
operation,
your
your
trade.
businesses. Yeah, purposes of a trade. Do you agree?
Yes, sir.
Okay, because you actively went there to conduct or to take photographs, to conduct business.
Yes, sir.
Right, so with this one, they look at the Burgess case. Okay, Burgess looked at trading activities, meaning you need to look at the business's core purpose. That's pretty much what they took out of the judgment. Right, basically your trading activity. So if you're trading as a business providing for photos, okay, and maybe also as a business, maybe at some point in time you decide to sell equipment. That's possible.
Yes, sir.
Okay, and then you grow the business. But that's always what they're going to look at. They're going to look at your activities. They're going to look
Yes.
at what did you do in the business that brought in income. That's what they're going to look at.
Yes, sir.
Right, and if you took photographs that brought income, chances are that's going to be classified as income.
Yes, sir.
Right, and if you sold your camera 1 year and you didn't sell the camera the next year, they'll probably view that as capital because you'd be able to prove that you haven't done that often. Buying and
Yes.
selling those goods.
Yes, sir.
Makes sense.
Yes, sir.
Okay, and it's specific to the business. That's the most important thing. Okay, just something for you to consider. If an expense is not deductible according to the general deduction formula, do you think it can still be deducted? Yes or no?
Yeah, I think so. No, I don't think so.
If it's not deductible,
Well, if it's not deductible, then I don't think it can still be deducted unless it's excluded from the taxable income.
okay, well, be careful. When you say if something's excluded, you don't actually exclude the deductions. Deductions are actually included or not included. Does that make sense?
Yes, sir.
The exclusion you're kind of looking at is the income part.
Yes, yes.
Okay, where I don't put in the income. Right, but here we're actually looking at deductions. Okay, so allowable or non-allowable deductions.
Yes, sir.
Right, so if an expense is not deductible, meaning it cannot be deducted according to the general deduction formula. Right, can it still be deducted? Well, the answer is possibly, as long as it meets a specific deduction.
Yes, sir.
Okay, like you get specific inclusions, you also get specific deductions.
Yes, sir.
Right, so do any specific requirements have to be met for deductions to be allowed? Any idea?
No. Yes, they have to.
Well, what comes to mind?
Well, first it has to be within the confines of a trade. I think we just looked at them, so like
law.
Yes, sir.
That's important, right? So let me ask you this, have you ever rushed to a photo shoot and you got a speeding ticket?
No, sir, never.
You've never? Okay, that's interesting. So you've always been on time for your events. That's good. So let's say, if you got a speeding ticket, was that actually incurred? Did you incur that during the 12 months?
Yes, sir.
Yes. Was it during the year of assessment? Yes. Was it in the production of income while you were traveling to the event?
Yes.
Is it not of capital nature? There's no enduring benefit. Do you agree?
Yes, sir.
And was it later or expended for the purposes of a trade? Well, yes, you are rushing to the event. Do you agree?
Yes, sir.
So does the speeding ticket meet the definition of the general deduction formula?
Well, it does, but I don't believe
But would you be able to claim it?
No, sir.
Why not?
Because speed, either way, whether it was within your production of the production, well, even if it was while you're trying to conduct business, you still broke the law by speeding.
That's the key. Okay, you cannot break the law. All right. Yes. So the first page that I've given you here is looking at specific deductions. Okay, so what do these do? Do these meet section 11A? Yes or no?
Yes, sir.
No, they don't.
No, sir.
Because they're specific deductions.
Yes, sir.
Okay, section 11A is for what type of deductions? General.
Yes, sir.
Right, because let me give you an example. Let's talk about this last one, prepaid expenses. If something is prepaid, did it actually incur in the year? Was it actually incurred?
No, sir.
It was incurred, but not for this year.
Yes, sir.
Okay, because it's prepaid. It's actually incurred for next year. Does that make sense?
Yes, sir.
All right, so would you be able to claim that as a general deduction?
No.
No, because it doesn't meet the definition of general deduction.
Yes, sir.
Right, because it wasn't actually incurred. That's the big problem.
Yes, sir.
All right. Other things like legal expenses, restraints of trade, registrations of patents, copyrights, designs, and trademarks. See, here I've tried to give you a summary from the textbook. Okay, so if it's less than 5,000, you get the full deduction.
Yes, sir.
If it's greater than 5,000, you get a 5% if it's a copyright or 10% if it's a design. See that?
Yes, yes, sir.
Okay. Research and development, also something that isn't part of the general deduction. Because remember, research and development, does research and development have an enduring benefit?
Yes.
Yes, it does. Okay, if you uncover a new patent for a new product, will you get future benefit from that patent?
Yes, sir.
Yes. Okay, the research and the development might have created a new invention. So that would be capital in nature, do you agree? And then that doesn't meet the general deduction formula.
Yes, sir.
But would you still be able to claim some of it as an expense, as a deduction?
Yes, sir.
Possibly, because of a specific deduction. Do you see the difference?
Yes.
Okay, same thing with bad debts and credit losses. Bad debts. Does the bad debt incur during the year of assessment?
Well, yes, sir.
Yes. Was it actually incurred?
Yes, it was, sir.
Yes, it was. Was it in the production of income?
Yes, it was.
No, it wasn't. Bad debt, not in production of income.
Oh, no, not in
producing any income. Bad debt was just a write-off of previous bad debts. Previous debtors. Does it make sense?
Yes, sir, that makes sense.
Yeah, so bad debt would fail this. Bad debt would fail that one. Bad debt might even fail this one, possibly. Okay, so some things you can include, some things you can't. And if it's a specific deduction, you will always be able to include it as long as it meets the requirements laid out in the Act.
Yes, sir.
Okay, and all of these line items that you have on the slide come from different parts of the Income Tax Act. Okay, that's why the legislation is very good, because if you go to the legislation, SARS will tell you exactly what they will and won't allow you to claim.
Yes, sir.
Okay. Things like employers' contributions to pension or provident, you can claim 10%. Okay. Donations, you can claim within the 10% limit. We looked at that in some of the questions from last time in terms of the assignment. We'll look at more later on when we get to separate questions. Annuities to former employees, also something that we looked at as well. And in the prepaid expenses, less than 6 months or less than 100,000, you can claim the full amount, even if it relates to a future period.
Yes, sir.
Right. So, don't you think prepaid expenses can be quite useful?
Well, yeah, I think they could be actually.
They could be, because you get to claim something this year that relates to next year.
Yes, sir.
Right, but as long as it's part of your income, and as long as it's less than 5,000. Okay,
yes.
Not 5,000. Sorry, 10,000, 100,000. Okay. Yeah, the 5,000 thing was the trademarks and stuff, patents. That was it. Okay, and then just a note here about prohibited deductions. If something is prohibited, can we claim this?
No, sir.
No, we cannot. These are non-allowable deductions that meet the definition of Section 11A. Okay,
yes,
the one
sir.
that we spoke about earlier, a speeding ticket. Would you be able to motivate if the speeding ticket meets the definition of general deduction? You definitely could.
Yes, sir.
But the only thing that it falls flat on is this: corrupt or unlawful activities. Section 23O provides for things that you cannot deduct. They are prohibited.
Yes, sir.
Okay, so an insurance loss, it's prohibited. You cannot claim that. Any tax or penalties or interest that you have to pay to SARS, you cannot claim that. Provisions you cannot claim, but a portion of a provision you can for a specific provision. Remember the bad debts provision?
Yes, sir.
Okay, that was I think it was 25%, if I'm not mistaken. 25% of the provision of doubtful debts you can claim. Okay, but remember that's a provision for doubtful debts. There's it, see? Provision for doubtful debts. Other ones. Expenses to produce exempt income. If you're producing exempt income, the expenses that you use will not be deductible, because then you're going to be claiming stuff on income that will never be taxed. So remember, what does SARS want to do? They want you to pay tax, but they want you to pay tax in line with your operations. So if you incurred expenses to generate income, SARS says, well, we understand that it costs you a certain amount of money to run and create the business, and therefore they'll allow you to claim certain expenses for those certain expenses for that income. Got that?
Yes, sir.
Okay. Non-trade expenses, obviously not. Restraint of trade payments, obviously not. Right, something else to consider here: unlawful activities, fines and bribes, and anything that does not meet the general deduction formula. Okay, so prohibited deductions are very, very, very specific. Other prohibited deductions include income carried to a reserve fund. Okay, so if I take income and I post it through to a retained income, if I keep it for future periods, that posting, okay, can I claim that as a possible deduction?
No, sir.
No, you can't. Okay, money is not expended for the purposes of a trade, obviously not. And any taxes, levy, duties, interest, penalties, anything under the Act, you would not be able to claim that. Okay, so if you incurred interest on your non-payment, or if you incurred a penalty, if you incurred anything along those lines, SARS will not allow you to claim those amounts. Got it?
Yes.
Yeah, it's pretty basic. Okay, then this is that whole idea with the opening and closing stock. You probably remember me speaking about it last time when we did the assignment.
Yes, sir.
Okay, so the only reason why I've given you the slide is to talk to you about the periodic system. The periodic system has an equation to calculate cost of sales. Cost of sales is opening stock plus purchases minus returns plus other minus closing stock. Okay, so will SARS allow you to claim your opening stock?
No, sir.
No, they will. It's claimable. Yeah. Why is it claimable?
Because you need it to generate income?
No, because opening stock is added to your cost of sale calculation. So if opening stock goes up, okay, you have cost of sales. What is cost of sales? It's an expense. Will they allow you a deduction on your expense?
Yes, sir.
Yes, they will. So any opening stock that you have in the business, they will allow you to claim that as a deduction.
Yes, sir.
Okay, the closing stock. Will I be allowed to claim my closing stock?
No, sir.
Why not?
Because it's being deducted from your cost of sales.
Yes, it hasn't been incurred as an expense as part of your cost of sales. So closing stock means we've still got stock sitting on the shelf that wasn't sold. Okay, yes, so closing stock does what? Well, if closing stock goes up, okay, you have a bigger negative. The bigger the negative, the bigger or smaller the cost of sales.
When you have a bigger negative, you have a lesser cost of sales.
Correct. You have a smaller cost of sales. Meaning, will the deduction be greater or smaller?
The deduction will be smaller.
Exactly. The deduction will be smaller. Right. So do you see how you can remember the opening and closing stock just by using the accounting equation for cost of sales?
Yes, sir.
I find that's the best way to remember it. Okay. Or you can just study it. Okay. It's just something else to consider when looking at stock. If I'm buying stock and I want the stock to be delivered to my business premise, can I claim the cost associated with bringing the stock to the office?
I believe so.
Why?
Well, it's a cost that you're incurring within your business to be able to generate income.
Very good. So does that meet the definition of the general deduction formula?
Yes, sir.
Yes, it does. And if it does meet the general deduction formula, then Section 11A is applicable.
Yes, sir.
Right, so things to also consider here is the setup or delivery or purchase of the stock. Cost of transportation, import duties, carriage, railage, insurance, handling, etc. can also be included. Right, so that covers the notes. I do want to show you one example though, before we wrap up. So let me just open up one of the examples, and I want you to tell me whether or not we can claim this deduction. Okay, let's go to chapter 5. Yes, chapter 5 is in the new book. Okay, let's find one of the examples here where they spoke about the general deduction formula. I want to get the general deduction formula one. It might have been in the practice activity. Let's see. Yeah, prepaid expenses. That's fine. That's fine. Where's the practice activities now? Let's check. Oh, there we go. Here's a good one. Case study 3. Okay, let's discuss this one. Okay, so Unam, you will see questions like this often. Alright, that's why I'm trying to practice and trying to do this, because you're going to see questions like this come up. They often test the general deduction formula, and it can be for as much marks as 13 or more.
Yes, sir.
Okay, so what do you do when you get a question like this? Immediately go to your slide. Okay, you go to this one, and you write down all 5 bullets. 1, 2, 3, 4, 5 bullets. You write them all down. And then you talk about each one. When you talk about each one, you could even talk about the cases. For example, when I talk about actually incurred, if I want to impress the marker, I can talk about the Edgar Store case, possibly.
Yes, sir.
Okay, in your discussion, because that motivates whether something is deductible or not.
Yes, sir.
Okay, so let's see if you can do this one. It's on page 23 of the second book. Okay. Here's it there. If you don't have the book, you can just read it on screen. Okay, but I want you to read it, and I want you to think about the general deduction formula. And then I'm gonna, you've got the notes, and then put the general deduction formula in front of you, and then take me through each one and tell me whether this is claimable or not. Okay.
Okay, just give me a second, sir.
Let's see how that goes. Okay, this is something that I have seen them ask students in the past. It's a very common exam question.
Okay.
General deduction formula.
So on page 23, case study
3, the one on screen.
Right. Do you mind if I read it quickly?
Read it out loud so we can discuss it.
All right. Martinez Hair Studio CC is a hairdressing salon. The salon is run from a shop that is situated in a shopping center. The salon pays monthly rental for the shop of 10,000 Rand on the 28th of each month. Apart from the set monthly rental, it also pays a 2% rental based on the annual turnover for the period 1 April 2017 to the 31st of March 2018 if the turnover exceeds 500,000. The turnover for the current year of assessment as at the end of February 2018 amounted to 485,000 Rand.
Okay.
Discuss the deductibility of... Okay.
Alright, so there's quite a few things here. Do you agree?
Yes, sir.
What do you have here? Give me a few things. Well, what are you thinking about? Look at it and tell me.
Well, I'm looking at the rental firstly, which is obviously probably in the production. It's something that you've incurred in the production of your income. I'm looking at.
Okay, you're not doing it correctly. What must you do with the rental first of all? Talk about the general deduction. So, what is the first bullet?
Well, actually incurred.
Okay, so was it actually incurred? Yes or no?
Yes, sir, it was actually incurred.
How do you know that?
Because we are at the end of our period and this was paid on the 28th of each month. So.
Correct. There you go. That's better. Okay, so actually incurred, happy with that. What's the next bullet?
I think the next bullet should be during the year of assessment.
Was it?
Yes, it was, sir.
Okay, fine. And? Number 3?
Number 3 was it was in the production of income. I believe it was, sir, because...
Explain why.
Because for us to have made income, we had to incur the rental expense for us to have a space in which to work out of.
Exactly.
It's the same.
That's what you need to explain in the actual write-up. Good.
Yes, sir.
Okay, so besides the space, you need a salon can't operate without the space, 100%.
Yes, sir.
Okay, next.
It's not of a capital nature.
So what does that mean?
Well, it basically means that it's not something that you are basically selling once off. So in other words, I wasn't just doing hair for that day. It's actually something that the business does as their main line of income generation.
Okay. So if it's not capital in nature, there's no enduring benefit, right? So talk about the enduring benefit part. That's actually more important.
Okay, sir.
Is there enduring benefits?
No, sir.
Okay, so if there's no enduring benefit, then this is considered income, not capital.
Yes, sir.
Okay, perfect.
Yeah. And then after that, unless Yeah, I think that was the last one, not of a capital nature.
Sorry? Yeah, not of capital nature. No, and then still uh, purposes of a trade, expended for the purposes of a trade. That was the
Oh,
last one.
expanded. Oh, okay, yes. Yes, it was expanded. Well, it was for a trade because obviously that's what you're trading in. You're giving your service of doing good hair or hairdressing for some sort of benefit or income.
Okay, so would the rent meet the definition? Would it be deductible?
The rent.
Would both rent be deductible? So we've established that rent is deductible. Do you agree?
Yes, sir.
Okay, but here they're asking you to discuss the deductibility of both the rentals.
Yes, sir.
So what about the other rental, apart from the 10 grand a month?
Yes.
What about the 2% rental based on the turnover?
Well,
From 1st April to 31st March.
from 1st April to 31st March, I think it would probably also be, sir. But then the only thing that I would be asking myself is, 31st of March, if you're saying that, then is it within the year of assessment, though? It doesn't look like it was.
No, it isn't. So that portion would be outside. Do you agree?
Yes, sir.
So do you agree the 31st March 1 month would be actually outside the year of assessment?
Yes, sir.
Okay, then you would have to apply the prepaid expense thing or the accrued income thing. You'd have to use something separate.
Yes, sir.
Okay, this would actually be this would actually be a prepaid expense if you're going to pay it for that period.
Yes, sir.
All right, so then you would have to apply that whole less than 100,000 thing for the actual prepayments.
Yes, sir.
Okay, so do you think both rentals would be deductible? Well, rent in itself would be deductible. Do you agree?
Yes, sir. Yes, sir.
And for me, the only thing here that you might have to consider and discuss further is that whole idea of the time frame, because of the 1st of April to 31st March. There is a consideration there.
Yes, sir.
Okay, but remember, the turnover for the current year of assessment is only 485. So did we exceed the turnover?
No, we didn't.
No, we didn't. So would you have to pay the 2%?
No, you wouldn't.
No,
sir.
you wouldn't. So that actually that doesn't meet the general deduction at all.
Yes, sir.
Okay, if it was greater than 500, then you would. But it wasn't, so we don't have to. Do you see that?
Yes, I do.
Okay, let's check what they said in the textbook study guide. Let's find case study 3. Here's it. Case study 3. Monthly rental expenditure. The 10,000 is actually incurred. It will be deductible and it meets all the general deduction requirements. Okay, we know that. Okay, annual turnover of rental 2%. Right, expenditure 2% of turnover exceeds 500,000. Actually incurred. Was it actually incurred?
No.
No. Why not? Because it didn't exceed 500,000.
Yes, sir.
You see that? So incurred means when you're actually required to pay it.
Yes, sir.
And you're not required to pay it because it didn't meet the 500,000 limitation. Right, so that kind of falls flat looking at the first one. Right, you don't actually have to go through the next steps, but you can if you want to. Right, is it during the year of assessment? Well, most of it is, but part of it isn't. Do you agree?
Yes, sir.
Okay, then they talk about in production of income. It relates closely to the running of the business, so it is part of production of income. So that's fine, because it talks about the performance of the business. Is it not of a capital nature? Well, it definitely isn't, because you're paying the rent. You're not buying a building.
Yes, sir.
Okay, so that's also not of capital nature. So some of the deduction formula it meets, but it doesn't meet all of it. So for something to be deductible, the key thing here is it must meet all the requirements. That keyword here is important, all.
Yes, sir.
Okay, you can't just meet half of it. You have to meet all of it. Does that make sense?
Yes, sir.
Okay, so if I meet 4 of the 5, still no deduction. It must be 5 of the 5 or nothing.
Yes, sir.
Okay, and SARS is very strict with that. Because remember, what does the deduction do to your income?
It reduces
It
it.
reduces it. And do you think SARS wants less tax or more tax?
They want more tax.
They probably want more taxes, yeah. So they're not going to really want you to deduct more things if it doesn't meet the full definition.
Yes, sir.
Okay. Right, and then they just go on and they say, well, Section 23 prohibits this deduction, it will not be deducted. Okay, so
Yes.
that's the kind of answer that you would have to produce. Right, and that's what you'd have to do. So you'll see, when we do past papers together, I literally copy-paste definitions. Why? Because definitions are things that you have to study. And then you just need to
Yes.
practice applying it.
Yes, sir.
Okay, happy with that?
Yes, sir.
Perfect. All right. So that's kind of what we needed to look at today in terms of all the deductions. Obviously, what I would suggest you do is try go through the examples in the textbook, or study guide rather, because the study guide examples are actually quite good because they're similar to the past paper questions that you'll get. And then if you have questions on specific questions, then let me know, and then I'll go through those in detail with you.